Good evening, this is Doc Severson for the TheoTrade Nightly Report for Tuesday, June 14th. The first chart tonight is the VIX Futures, the /VX here, and we have seen this movie before, have we not? Okay, so after the rally that we had in October, recall that we started to see the VIX Futures creeping up. So even though the price was essentially rallying or just kind of stuck in a sideways channel back in November and December, we saw the VIX futures creeping up, which meant that somebody knew something. And then, of course, as we got into the beginning of the year, or January, we saw this nasty spike with another spike as we retested the bottom. So are we not seeing the same type of pattern here where we have these sort of surreptitious higher lows showing up on the VIX futures? Right? So this is the same kind of unstable pattern that we're potentially seeing. Now, we don't want to read too much into this. Just because we have the same pattern doesn't necessarily mean it's going to happen exactly in the same manner the next time. But this shows right now that somebody knows something about risk right now, and they are hedging it off like crazy. Let's move over to the S&P. In this case, I'll just look at the Spiders ETF, which is a great proxy for the S&P 500, and it's got tremendous volume and liquidity. So it's what a lot of people are trading, and it gives us a great proxy for the health of the overall market. So looking at this chart right now, monthly, weekly, and daily charts, what I'm looking for here in just these price charts is just the trend and the character. What's going on with this? So right now, obviously, we're still seeing this big sideways pattern on the monthly chart on the S&P, about a 300-point range on the full S&Ps. We're seeing a very strong rally leg here. Now, getting a little bit weaker, but tops are a process, bottoms are an event. Bottoms are an event, tops are a process, right? So we're just now starting the process of seeing potential reversal signals. This does not necessarily mean that we're going to drop like a rock, but the process has started with the volatility going from very quiet and trending. Now, even this pullback was quiet, but strong rally up and a strong move back down to about 50% of this. So we're starting to see the volatility kick up. We're starting to see the VIX futures come online and light up again. So if you were thinking this is going to be a slow grinding summer, I think you might be wrong. I think we're going to start to see more and more volatility. I don't think it's going to be a repeat of what we had last summer up here in 2015. But regardless of the fact that we've had about, 3 days down now, we have not broken trend. Notice that all the higher highs and higher lows are still in place. We have not broken trend. We have not started the process of dismembering this marketplace yet. What would have to happen from here is either we see this print a lower low, so drop all the way down to maybe somewhere in the lower 200s on the spiders, and then bounce up and create a lower high. Or what we could also see from this chart is we could see this just with a weak bounce up, maybe after the Fed meeting tomorrow, and then that prints a lower high, and then the process of deconstruction starts. Now, a lot of people are on the bandwagon that we're about to see a move down to here again. And I'm not really one of those people. Sure, it could happen. We could see a revisit of the bottom of this range, certainly. But the change in character that we've had over the last few months is very, very different from what we've seen. We have the recent volatility and the number of tests that we've had of this 1800 level. Really, what I've been talking about lately is that we've corrected through time instead of price, where we should have been down in this level by this time this year. We haven't. So the market's been up to all-time highs, and the reason for that is, of course, all this central bank policy around the world driving negative interest rates, and with all that liquidity searching for a home for yield. So this is creating a floor underneath our equity market. So let's take a quick spin through the S&P sector spiders right now. This is the XLF for the financials. This does not really look good And I think the reason for this is because I think everybody knows that there's no way Janet Yellen's going to raise rates tomorrow. And I think she's going to be, even though the verbiage is going to be hawkish, I think people are basically going to respond to what's going on in the bond markets. And the bond markets are rallying like crazy lately, effectively sending interest rates down next to nothing. So banks have nothing to work with right now. And I think we'll continue to see the banks in the financial sector have difficulty maintaining this trend. So we may even start to see another leg down here. Ultimately, this is just a big, huge, enormous consolidation pattern or a triangle, but within this, we're going to see some huge moves before this finally breaks the grips of this pattern. Here's energy, which has been valiantly trying to rally since the beginning of the year, and it's done a pretty good job. 50 up to 67. I mean, that's a healthy move, but still you can see the weight of this monthly downtrend. We still haven't printed a higher high yet. We're still a lower high. So it wouldn't surprise me to see this roll over at some point, if at least to print a higher low and start the process of reversal, right? So long way to go before energy is out of the woods. We have, quite a downtrend in place here on the larger time frames. So within that, we're going to get some big swings. We're going to get some huge bear market rallies, but this is still in the grips of that monthly chart. It's going to take a long time before we see actual reversal signals. Here's consumer discretionary, and boy, right up near the all-time highs. Right up near the all-time highs. Now, keep in mind, this is a warning signal here. We're making higher highs and higher lows, and all of a sudden we print a lower low and a lower high. So this is not necessarily a good signal. This might mean that we're going to either, at best case, consolidate up in this area, or worst case, start heading down and printing a lower high there. So if consumer discretionary starts to fall down, if they think that retail sales are starting to peter out based on discretionary products, this could be a bad sign for the economy. We'll have to watch this one closely. And here's the XLB, the materials. Again, everything is, the trend is still there, but you can tell that this is obviously still slowing down right now. Nothing really to see right now in the builders. Now, some of the ETFs, some of the spider sector ETFs did okay today, such as healthcare actually was not bad. Still hasn't broken trend. Right now, what we're seeing is kind of the consolidation pattern up here, where we're seeing kind of like equal highs and a series of higher lows coming into this. So we'll see whether or not this trend line overhead gets broken, and that can cause sometimes a big squeeze to here. But a lot of indecision, obviously, in the healthcare field right now as we wind down the term of this administration. Here's the utilities sector spider, and this one was in a funk for a long time. And you can see that as we came down off the high and kind of chopped around here in 2015, throughout much of 2015, you can just see the patterns here. You can see how this reversal got started by printing a higher high here to a lower low, to a lower high, and then in a very important higher low. And that ultimately, as we got into 2016, started this rally as, frankly, a lot of these are dividend paying stocks, and the utilities very, the typical boring pedestrian stocks paying utilities instead of getting gains through the market. And this is what made them catch on fire, and they're just ramping into all-time highs right now. So there's no end in sight on these, but this is a type of pattern, this type of consolidation pattern. It's just like winding a spring, right? Winding it tighter and tighter and creating all that potential energy, and we're seeing that flying out of here to the upside. So we still have strong trend to the upside, but we're getting very close to seeing one of these absolutely vertical trends with an infinite slope to it, which typically means that the end is near, because these are unsustainable moves that create a lot of damage on the backside of them. Okay, here's the industrials. Not much to see here, really, about the same chart as the Dow. Here's technology. Technology is actually, this sector is stronger than the NASDAQ. At least the chart is stronger than the NASDAQ right now. So you can say that we are not close to all-time highs here. We've got a long way to go for that, but this consolidation pattern up here has been kind of churning around here for quite some time, and this actually could build up a lot of power for the next move for this, regardless of whether it's to the upside or downside. So watch the daily chart on this one. If we end up printing a lower low below there, we might be starting to see a reversal signal from here with that lower high. Watch that carefully, or you can just simply watch the all-time highs to be broken out again. And we'll finish up today with the consumer staples, and there's, boy, nothing wrong with this trend. You can see all this consolidation throughout 2015 just built up a lot of power for the eventual breakout to the upside. Again, I believe this is another dividend play that we're seeing with typically these types of companies. The consumer staples are the household names, and they pay a huge dividend, and typically they have gone nowhere in the market for years and years and years. They just went sideways. And again, you can view this as sort of, just kind of winding the spring up before eventually we started to see this thing really take off to the upside. But again, we're getting into that vertical slope again, nearly, an infinite slope. And these will always have a difficult time on the backside of them. So be very cautious with these, and I definitely would not be chasing after anything inside of this particular sector. The reversal signals for this, when it does come crashing down with gravity, will be the same as always. It'll start from, a very innocent looking move on the daily chart, which will start to move the weekly chart down, which will ultimately start to kick off the series for the monthly chart. So this is how reversals start to propagate. They always start from the inside out, the smallest time frames. So don't forget, tomorrow at 2 o'clock Eastern Time, 1 o'clock Central, we have Ms. Yellen coming out to, first of all, give the Fed policy, and then about half an hour later, they trundle her out on a cart, prop her up in front of the microphone, and then she commences to take a verbal statement, and then she answers questions from the assembled members of the media. So sometimes it can be extremely boring. Sometimes it can cause high drama if they don't say precisely the right thing at the right time. Janet Yellen is getting very, very good at saying exactly the right thing to get the desired result in the marketplace that she wants. So be very, very cautious of that. As always, these are market movers, and we will get some market movement out of this. Be cautious with the first move. Usually the first move is usually the wrong move that occurs right after the 2 p.m. release. So that's it for tonight's report. Thanks for listening, and we'll see you soon.